Vamos a analizar todo este cierre semanal, el sentimiento del mercado este viernes y también esos datos. Lo hacemos a continuación con la ayuda de Brian Vendin, es President and Managing Executive of MJE Wealth Advisors. Brian, hello, good afternoon. Thank you so much for attending us.
Great to see you again.
So we have just seen the closing of the European markets. It has been a week of falls, a red week, although calmer than the previous ones. How do you see investor sentiment?
I think right now, investor sentiment is still more to the downside than it is to the positive side. I think investors are still concerned about the path of inflation over the balance of the year and looking for signals if the supply chain inefficiencies are going to improve. At the same point in time, we got a strong jobs report today, which really added to the volatility because we didn't really see wage growth decline, and we know wages is a big impact to the inflation number. And as a result, caused investors to be concerned that the Federal Reserve is going to continue to be conservative or hawkish with its path of rate increases over the balance of the year and implementing quantitative tightening. So I think what really investors are looking for before they change their sentiment is to see, does headline inflation come down? Does the tone of the Federal Reserve communications change, as well as other central bankers around the world, similar to the ECB as well in Europe? And will we see inflation come down, which then will give some concerns that maybe some of the issues around a recession caused by rate increase start to diminish over the balance of the year.
The U.S. economy, as you just said, added 390,000 jobs in May. It is better than estimated, although it topped expectations. Job growth in May did slow compared with April. Investors have been looking for any signs of labor market weaknesses as the Federal Reserve raises interest rates to tamp down the high inflation. What interpretation should we do of this data?
Sure. So I think the jobs report is telling a couple things for us today. First, that the underlying economy is still strong. There's demand for jobs. There's a lot of job openings, still more now than we had pre-pandemic. But the issue that we saw was we didn't really see a huge uptick in labor participation, and we also didn't see overall headline inflation wage growth come down. And I think that's what's causing a concern for investors, is not necessarily the jobs number per se from a hiring point of view. I still think that people expect a tight labor market and a strong jobs market over the balance of the year as people are commanding a higher wage in the economy and also less fearful of coming back into the economy from a COVID perspective. But it's really more that wages is a big input into inflation, and the fact that it hasn't materially decreased is causing concerns that the Fed is going to continue to stay in this conservative or hawkish path of increasing interest rates. And we do expect 0.5 point increase this month, as they've telegraphed, as well as the same in July. It's really more, do we see that headline inflation comes down over the next couple of months so that possibly in the fall to the balance of the year, the tone of the Federal Reserve policy changes, which might bring some opportunity back to the financial markets. So I think you have to have a view off of where we are now of, do you think the U.S. economy is going to go into a recession, or do you think that the Federal Reserve can create more of a bumpy landing, let's say, with fighting inflation while at the same time giving an opportunity for the economy to expand?
Mm-hmm. But we have another data today. U.S. services sector activity has cooled further in May. The ESM of services decreased to 55.9 last month from 57.1 in April. It reflects a pullback in a measure of businesses activity that suggests a persistent supply constraints, which could be the evolution of services sector considering the current scenario.
Definitely, that's a great question. There's a lot of conflicting variables right now happening within the global economy. And I think we have to just take a step back and look at some of this data, especially the services data, to make a point that, you know, consumers are still spending and the services sector is opening within the U.S. economy. I mean, it's 68% of the economy. Definitely the numbers down month over month. but I don't know necessarily if that means that this is going to be a permanent contraction for the balance of the year. We still think that, consumers are healthy with commanding higher income year over year, still having balance sheet savings above historical levels. But we do expect that due to the higher prices of cost of living, that demand over the course of the year will come down. But at the same point in time, we do still see positive data that supply chains are becoming more efficient. So I think as the year goes on, and as more travel and more people look for experiences and getting back out there, that we should see, I think, the services sector improve, and we might actually even see a shift in demand from capital goods to services. So we definitely got to keep an eye on this. I don't think it's an indication of everything that will happen over the balance of the year, but it definitely is giving some concern to say, okay, is there less consumption happening, and as a result, this is an indicator that an economic recession is around the corner. And again, as I said before, I just think it's too early to make that call. We still think that the underlying economy is strong, and we're not expecting a recession in 2022.
And let's move to the Federal Reserve. Today, Brian has participated in a discussion about banks and credit needs. There were no messages about monetary policy, but this Thursday, she said it's very hard to see the case for the Fed pausing rate hikes on September. What do you think?
Thank you. I think that's a great point, because I think what the vice chairwoman said is that the September meeting is truly going to be a live meeting. Keep in mind, they've telegraphed that by the end of July, the Federal Reserve is going to increase rates by 1%, 0.5% this month, 0.5% next month. But I think in September, it's truly going to be a live meeting where it is data dependent. And I think what the vice chairwoman is saying is that we need to see over the next couple of months if some of these recent data points start to point to a trend that headline inflation has peaked or is peaking and starting to come down. And I think as of right now, they're keeping all tools available to fight inflation as their number one priority. But if we start to see that inflation does moderate slightly over the next couple of months, then the tone of the Fed communications might change. We might not see 0.5 percentage point increase. We might only see 0.25%. I don't think the Fed's going to stop increasing rates, and I definitely think the bond market has priced that in, that there'll be rate increases consistently over the balance of the year. The question, I think, is more about the Fed's outlook on inflation, thinking about things past 2022. Because again, they're saying that inflation is going to come down to 2%. But I think we all know that the cost of living is higher. And does that really seem reasonable in those out years? So what I'd like to hear in the September meeting from the FOMC is 2% still a reasonable target for 2023 and 2024? Or should we raise those expectations to 3% or 4%, thinking about globalization changing and the cost of living staying higher longer due to supply chain inefficiencies? And if that was the case, I think that might be welcome news to the market, because then moving forward, we might not need to see as drastic rate increases as we've seen so far this year, because we know the Fed is making up for lost time. So hopefully that makes sense.
Okay, and finally, Brian, I want to ask you about the European Central Bank meeting next week, next Thursday. There is a debate right now between its members about 25 basis points or 50. What do you think? What will Christine Lagarde tell us next Thursday?
Well, I think from an ECB perspective, I think it's really important to balance out that rate increase when they are looking at the European economy being very dependent upon natural resources and other inputs that power the European economy from an export perspective. So I think we've seen in some different parts of the European Union inflation reaching significantly high levels. And so if the ECB is trying to stay in parity with the United States Federal Reserve System, it's probably reasonable to assume that we'd be on a higher end of a rate increase in Europe to stay focused on inflation, make sure that the ECB doesn't get too far behind the curve, but at the same point in time, trying to look for indicators of what is the probability of an economic recession moving forward due to supply chain shocks, and dependency on different energy and natural resources. So I would say follow the trends of probably what's going on in the US to make sure that on a global basis, most monetary bankers are staying synchronized. I think that's their primary objective in the short term.
Okay, so Brian Vendin, thank you so much for attending us. Have a nice day and a nice weekend. It was a pleasure.
Thank you. You as well.